Is it?
Sorry, I think I lost my signal. No issues.
Okay. Sure. So now let's briefly look at the IPO details. So this company came up with IPO last year only, I think in September, and they raised around 1300 crores, but 100% of it was offer for sale. Predominantly, their previous investors uh, they cashed out, and the promoters also reduced their stake during this IPO. So it was a successful IPO in the sense that it received a good oversubscription, uh, both on QIB and also on non-institutional basis. I think listing wise, it was more or less flat, but today if you look at the stock is still below the IPO price, right? So that is about the IPO. Now coming to the financials, uh, what is surprising is that the FY21 revenues and EBITDA and profits were higher than FY20. If you compare that with any OEMs, any other auto ancillary companies, you will not find it, because most of the auto ancillary business they had a very tough time during the lockdowns, right? So Q1 and Q2 was a washout. Even they claim that their Q1 and Q2 was washout. They didn't do much, but in Q3 and Q4, Q4 results are not yet out, but Q3 they have done really well, and new orders have basically helped them a lot during this period. That is what they have mentioned in the con calls, but it is still early days. Just the IPO has happened, and we are seeing these kind of results. If you look at the EBITDA margin, considering the auto ancillary space, their EBITDA margin is on the higher side, uh, and the kind of precision and quality focus they are, it is natural to assume that they should have these kind of EBITDA margin. But let's see uh, how they progress from here. Say if FY23 remains a normal non-COVID year, even though the COVID number of COVID cases are rising in India also now, but let's assume that it is not a worrisome sign and we have a normal year FY23. How they work in this kind of a year and what kind of revenues, profit, and margins they get is something which we have uh, to track, right? But given the what kind of ROC they have generated in the past, like you can see in FY19, it was around 19%. And if they manage to do something like this could be an interesting company to look out for. If you look at the last quarter's numbers specifically, you'll see that, uh, of course, the EBITDA has gone down because of major reason for that is uh, the commodity rise, and also the management has mentioned about the rise in the employee cost. There is some sort of this ESOP also, some one-time ESOP also was granted during the current year, which has led to a reduction in the EBITDA margin, right? So this is more about their revenues, EBITDA and PAT. Now, this gives a very good picture about how they are present today in terms of geographies, in terms of, and also in terms of the end use segments. So you can see even today, they are predominantly dependent upon the the auto ICE, which is the old school auto. That is what you can call it, right? And whether they manage to increase their EV contribution or the non-auto contribution, that is something we have to track, because as per what management guides us in the con calls, they are trying their best to expand to non-auto segment, to build their capacity where they are into auto tech agnostic and EV space. These are the two areas where they want to grow really aggressively in the next 2-3 years. And if they manage to do that, that should ideally be better for them, because that will also de-risk their business from the auto segment. Because auto for a long period has not been performing as a sector. I'm not talking in terms of the price movement. I'm talking in terms of the volumes which you see in the auto industry, right? So it was already under doldrums prior to the COVID, and post-COVID, something keeps on happening. Right now, it's the chip shortage issue, which has kept the industry under check even till today. So I think today only I read some news somewhere that one particular, just a second. Yeah. So basically, the auto industry is still not doing well, and auto industry will continue to be a cyclical industry, which we have seen over the last several years, right? So the more you diversify and the more you